Learning to invest doesn't have to be as complicated as it's made out to be. Wall Street and big finance companies want to trick you into believing these myths, because then you're reliant on them for their advice, and they can easily sway those that don't know any better. In today's video, I'm debunking 5 myths around investing and how everyday investors like you and I can succeed. Myth number 1, investing is too risky. Guys, I'm here to tell you that yes, investing in anything in exchange for a return comes with some level of risk. But if you think going to college or starting a small business doesn't have some risk, if you've spent 3 years studying away only to be forced to drop out for some extenuating circumstance, or more likely to happen, you just had a change of heart on the subject matter and changed your degree plan. Maybe you did it 10 times like yours truly. Starting a small business may mean devoting countless hours of blood, sweat, and tears into a passion project. Something you've always dreamed of doing, but comes with no guaranteed return. In the wise words from someone I've never heard of before, everything worth doing involves risk. The number one reason why people turn to stock market investing is to grow their wealth. It's because it's a risk asset. Volatility is often described as the risk of your investments going down in value. But you know what else happens when the assets you currently hold go down in value? You get a chance to buy them at cheaper prices. If you liked buying something at $100, why wouldn't you like it even more at $75? Or even more at $50? Assuming the fundamentals are still there and haven't changed your long-term view of the holding, you should be excited when the stock market is falling. Myth number 2, I'm too old or too young to start investing now. There's no age restriction on making sure your future is well taken care of. If you're 55 years old and haven't started saving for retirement, it's not worth wasting your energy on regret or thinking about what could have been. Instead, you should focus only on what's in your control to change and how you're going to change it. If you're 20 years old and you think that retirement is a lifetime away, you're literally wasting the best advantage you have in the world of building wealth. Time. Compound interest is described as the 8th wonder of the world because it has an exponential power to grow and is unlike anything else if used in the right way. Saving just $100 a month from age 20 to 65, you will have greater than $1 million. This example is so popular to use because it illustrates the amazing effects of compounding interest. But what I really want for you is that you'll learn how to dream big and see how achievable those dreams really are if you have time on your side. Now, I know that what I'm about to say is going to shock a lot of you, and before you go roasting me in the comments, just hear me out. I get it. It's hard when you're 20 years old to think about saving for retirement, much less actually living on less than you make. What you probably don't realize now is that your income is far from stagnant. If you put in the hard work and stay consistent, you're likely going to see your income do something like this over the course of your life. If you focus on your saving rate and not the dollar amount, say 20 to 25% if you're just getting started, increase the percentage over time as you advance throughout your career. I'm going to link my favorite time value of money calculator in the description below. I encourage you to explore it, playing around with different saving scenarios and seeing for yourself the value of compounding interest. My only goal on this channel is to teach and educate on FIRE or financial independence and retiring early. If you're enjoying the content so far, go ahead and hit subscribe and the bell button so you get notifications of any new videos. Myth number 3, I need to time the market. If you're an index fund investor, you have zero business trying to buy and sell into and out of the market. Your only thought should be, how much can I buy and how often can I buy it? Timing the market is nearly impossible for even the most savviest of investors. So what if you time the market perfectly on the sell of your investments? When are you going to buy back in? Now you have to be right on 2 separate occasions. And even if you are right, how much are you really saving? 10, 20, 30%? Other things have to be considered in order for it to be a fair comparison. Capital gains tax is a compelling reason not to sell. Now, I like to invest in individual stocks as well. And for me, timing the market is never a consideration. However, I do buy opportunistically. If the prices of companies I hold are trading cheaper than when I bought them for, as long as I still believe in the company's long-term growth and valuation, I take every opportunity to continue buying more shares for cheaper. If you want to learn more about investing for beginners, at the end of the video today, I've linked a playlist you should check out. Myth number 4, avoid debt. This myth does have a little bit of merit, but people don't understand the value of holding some good debt. Just like with many things in life, too much of anything can be bad for you. Even water. We all need water to survive, but in excess quantities, drinking too much can cause overhydration. That can lead to organ failure. Debt is just a tool in your toolbox. But like other tools like nail guns and saws, these can be misused and can cause you serious harm. The misuse of debt in the form of credit cards, excessive student loans, and high interest car loans can lead to so much pain and suffering when it comes to personal finances. To avoid the pain of debt, you need to know what are good forms of debts. Mortgage, student loans up to 1 times your starting first year salary. Credit cards can be used if you're going to pay off the balances every month. Promotional purchases, if you get a 0% interest rate and you know you're going to pay the balance off before interest charges. Myth number 5, I need a financial advisor to manage my finances. If you plan to turn over full control of your assets to a financial advisor, that is a terrible idea. Most advocates in the FIRE community believe in either managing their own portfolios or hiring a fee-only advisor. Years ago, it was commonplace to turn over control of your portfolios to your advisor. They would make the investment decisions and you'd get a quarterly statement of the performance. But being that far out of the loop creates fear and uncertainty. You're going to feel more empowered and in control of your future if you are a key decision maker in the investment decisions. Avoiding high-fee AUM financial advisors is an excellent way to boost your long-term future returns. Fees deducted from your fund's performance are a quick way to lose 1 to 2% annually, which compounded over the life of your investing career can lose you 25% of your total investment. So if you're new to self-managing your portfolio, I'd recommend going with index funds or ETFs. If you want to add in some individual stocks as well, that's a great way to boost your returns, but it does come with a lot of extra work and attention to really learn how to invest. How's that for a valuable myth busting? Thank you all so much for watching, and if you want to check out the playlist on investing, check it out right here. We'll see you in the next one.